Welcome to Eggs and Issues, a monthly business forum presented by the Portland Community Chamber of Commerce, bringing timely economic discussion to the region for nearly 40 years. Thank you to our sponsors and partners. Presenting sponsors, Martins Point Healthcare, Bernstein Scher, and Central Maine Power. Cooperating sponsors, Harvard Pilgrim Healthcare and Bank of America. Reception sponsors, Clark Insurance, Key Bank, and Pretty Flaherty. Community Corner sponsor, Goral Palmer. Tomorrow's leaders and entrepreneurs sponsors, AAA Northern New England and ProSearch. Coffee sponsor, Skowhegan Savings. Parking sponsor, M People Credit Union. Photography sponsor, Wohler & Company. Media partners, radio sponsor, WGAN. Print sponsor, Maine Trust for Local News. TV sponsor, WMTW Maine CW. Business news sponsor, MaineBiz. Venue partner, University of Southern Maine. And thank you to our special community partners, Anthem Blue Cross Blue Shield, Kennebec Savings Bank, MEMIC, Spectrum Healthcare Partners, Southern Maine Community College, and the University of Southern Maine. And now, please welcome Portland Community Chamber President, Mary Costigan.
Good morning, everybody. Happy New Year, and welcome to Eggs and Issues. My name is Mary Costigan. I'm a shareholder at Bernstein Scher, and I am honored to serve as the volunteer president of the Portland Community Chamber of Commerce. Today's topic is 2025 Economic Outlook, Navigating Change. We'll invite Senior VP, CIO, and Chief Economist from NBT Wealth Management, Ken Enteman, to the stage to discuss a multitude of topics this morning, focusing on an overview of what the new year and new administration in Washington have in store for our economy in 2025. Before I invite Ken to the stage, I want to thank all of our sponsors of Eggs and Issues that make this event possible for the entire season. Without our sponsors' support of Eggs and Issues, the Chamber would not deliver the high-quality speakers, panels, and presentations you've come to expect. So thank you to our sponsors. I'd also like to welcome One Stop Event Rentals, our new 2025 event sponsor of the Portland Regional Chamber of Commerce. We're thrilled to utilize their items and amenities from lighting and AV to linens and furniture at many of our chamber events this season. I'd also like to extend a very sincere thank you to our special community partners. These businesses and organizations support not just Eggs and Issues, but all of the 70 events the Regional Portland Chamber of Commerce produces throughout the year. Now on to our community corner. At each Eggs and Issues, we highlight a local nonprofit that's making a positive impact in our community. Today's community corner is the Maine Academy of Modern Music, or MAM. MAM uses the power of music to inspire students, foster creative collaboration, and build community. Now I believe they have a video to share with us this morning to help us learn a bit more about what they do. for those of you who remember the Old Port Festival, I remember always making sure that I went to the MAM stage because they did amazing things. So through strategic partnership, MAM is able to ensure that every young person wants to make music that has the opportunity, regardless of their circumstances. I believe there's members of MAM here today. They were out on the table. If you could please stand and be recognized. If you have any questions or want to be involved, please visit them back at the table after today's presentation. Thank you. Our Tomorrow's Leaders and Entrepreneurs program allows area high school, technical school, university, and college students to attend all Eggs and Issues events at no cost. If we have students here today, if you could please stand and be recognized. Thank you. Thank you for getting up early on this cold morning and joining us today. This is tough. All right, a quick reminder that complimentary parking is available for all that attend Eggs and Issues today and throughout the season. So you just scan the QR code outside if you haven't, and follow the directions. And if you need to ask somebody a question, there's plenty of people to ask. So now on today's program, we're going to welcome to the stage Senior Vice President, CIO, and Chief Economist from NBT Wealth Management, Ken Entenmann. Happy New Year, Ken.
Happy New Year to you. It's great to be here. Great to see everybody out in this cold morning.
I know. Thanks for joining us.
Yeah.
So I am going to admit right off the bat that I did not write these questions, and I don't even understand all of the words in the questions. But I'm going to ask them, and Ken is going to educate all of us. So here we go. Your presentation today is titled Managing Expectations, and over the last several years, expectations around the direction of the economy, interest rates, and unemployment have revolved around whether or not we would experience a soft landing as we recover from volatility in the rate environment and structural changes in the workforce. Where are we at with that soft landing, and where do you see U.S. GDP growth going for 2025?
Yeah, so for you theater goers, we've had this waiting for God it recession really for the last 3 years. We've been waiting, and every forecast was, well, next quarter the recession's going to come, and it just hasn't. If you look at this chart, we're still waiting for final numbers for GDP for the fourth quarter of last year. But our economy is growing at around 2.6, 2.7% for 2024, which is a pretty solid number. The estimates for the fourth quarter got as high as 3.3. The Atlanta Fed just brought it down to 2.77%. But at 2.7%, that's above trend growth. So we've had really surprising economic growth over the last 6 or 7 quarters. And in fact, the last 6 quarters, GDP growth has come in substantially higher than economic forecasts. So ignore all those talking heads out there, and I include myself in that category. The economy has been doing pretty well, growing at around 2.7%. It has been fueled by consumer spending. Our economy here in the United States, which is very unique around the world, but our economy is basically 2/3 driven by consumer spending. So it's a service-oriented economy, and the consumer is in pretty good shape, as we'll talk about in a little bit, driven by relatively strong employment. And the inflation story, while it's improving, is proving to be a little stickier than perhaps what the Federal Reserve would like. But I think all in all, we're starting 2025 in a really good kind of strong spot. So have we achieved the soft landing? I would argue yes. And the typical causes of recessions, which would be an economic shock, think of the financial crisis or the COVID pandemic, those are hard to predict, but hopefully none of them will come our way. Really high inflation. While inflation was high, it's running a give or take 2.5%, 3%. So I don't think inflation's going to cause a recession. So I think we're going to be kind of steady as she goes for 25.
Thank you. Now let's turn to what has become our favorite topic at the Chamber, housing. One of the bigger stories around the rate environment has been its impact on the housing market. How has the rate environment impacted existing home sales and housing affordability? And with the historical outlook at fluctuations in the Case-Shiller Index, where do you think we're heading in the near future on housing affordability?
I would love to give you happy news here, but I think we have a long way to go on housing. The fact of the matter is, throughout the country, there is a very serious shortage of single-family units, whether we're talking about apartments or single-family homes, measured in the millions, somewhere around, depending on who you ask, 3 to 5 million unit shortage. And that is not something that gets fixed quickly. We'll talk a little bit later about regulation, but sticking a shovel in the ground to build an apartment complex or a housing project, a housing development, is not an easy task. So this chart kind of gives you where we are. Existing home sales have collapsed, so the housing market has really been in a recession for 2-3 years. And that affordability is a function of two things. What is the mortgage rate, and what are house prices doing? So at NBT Bank, we're headquartered in New York, but we're basically in New England, in all the states, so Connecticut, New Hampshire, Vermont, Maine, Massachusetts. And in our geographic footprint, so call it New England, ex-Boston, ex-New York, housing prices over the last 3 years are up 41%. Wow. That's the number. So that it's great if you own the house. It's not so great if you're looking to buy one. And so that's one function of the affordability, and you can see the bottom half of this chart, whether you're looking at the Case-Shiller Home Price Index on a national level, you can see that kind of exponential rise. And even if you look at it as a percent change, you can still see that it's still relatively high. And then on your top right is the 30-year fixed mortgage, which, listening to a segment on housing yesterday, the national 30-year fixed mortgage rate is 7.1%. So we have two hopes for housing: that interest rates come crashing back down. I don't think that's in the cards right now. So it really comes down to housing prices. And in my opinion, you have to grow your way out of it. And I think we need some pretty meaningful reform when it comes to regulation in terms of actually building housing to make a big dent on it. And even if we all decided we're going to finance all the real estate development projects to get housing units up, we all know that doesn't happen overnight. So unfortunately, I think housing is going to remain a problem. And one of the things that we've seen from an economic standpoint, kind of in the post-COVID world, and I hesitate to use the word beneficiary of COVID because it was a horrible thing, but places like Portland and New Hampshire were beneficiaries of COVID in that there was this migration out of the big cities, Boston and the New England market, New York, Philadelphia. There was this migration out, which just already exacerbated an already challenging affordability situation. So I'd love to give you happy news on this, but I think it's a real challenge and it's going to take a lot of time to fix.
Yes, yeah. In my line of work, I know a little bit about how hard it is to get a shovel in the ground, so yes. We're going to work on that. As we know, the health of business is inextricably linked to the health of consumers. Business sentiment has fluctuated significantly in recent years, but through it all, consumers, as measured by the labor market and surveys of household wealth, have held up quite well. What explains the strength of consumer confidence and how this has translated into current business sentiment?
Yeah, so the U.S. consumer has been the superhero of our post-COVID economy. I mentioned it earlier that it's 68% of our economy, and they are spending like crazy, and they are carrying our economy. So when we break down the economy and we look at services versus commercial or manufacturing, manufacturing has been struggling for really the whole post-COVID environment, where services are off the charts. And it's fueled by the consumer. And that waiting for got-it recession, all you hear is this negativity that the consumer is going to fall off a cliff. It's going to be Thelma Louise, and they've been going great, and now they're just going to drive off the cliff. I don't think that's going to happen. And the reason for it is we still have an incredibly strong labor market. Unemployment at 4.1, 4.2%. Yes, it's up from 3.5, but 4.1 is still considered full employment on any historical measure. So we've had a relatively strong labor market, and that obviously, from a consumer standpoint, when you get laid off is when you stop spending, clearly. So we've had this really strong labor market. But the other thing that happens is if you look at the consumer, and we tend to think of businesses in terms of balance sheets, but we don't think of households or consumers in a balance sheet accounting way. But this tries to do this. So you hear all this negativity about credit card delinquencies are up and deferral payments and they are all starting ticking up from virtually zero. So the credit world is pretty pristine for most consumers. And this chart, I think, is really powerful. So if you look at the first bar, that's the asset side of the consumer balance sheet. So there are two really big chunks on the asset side, and everything else is kind of ancillary. So one is homes. Well, what's happened if you own a home? I just mentioned earlier, 41% in the last 3 years. So there's a wealth effect to your home. You have equity in your home. And then secondly is financial assets, whether it's your 401k, your IRA, your savings account. And the S&P 500 just posted its second consecutive year of 20% growth. So when you look at the asset side for the average consumer, the assets have gone up materially. Then when I turn my attention to the liability side, and you hear all this talk about student loans and auto loans and credit cards, well, look at the chart. All of those things barely meet the threshold of making the chart. The mortgage is the liability for the average consumer. And unless you've been sleeping under a rock in the last 3 years, what have you done with your mortgage? You refinanced it. So Tim McCown, who I shouldn't mention, but my manager of my investment research process, he refinanced his home at 2.5% for 30 years. That's a pretty big savings. And so when you put the combination of this, household net worth, and this is as of the third quarter, given the strong markets, I would put this number probably around $154 trillion in household net worth in the United States. That is a really strong consumer. It doesn't mean we can't go into recession. It doesn't mean the consumer can't slow down or the economy can't slow down. But the superhero of our economy that's been driving the economy has been consumer and consumer spending. And when you look at this assessment of their balance sheet, it doesn't mean they can't peel back a little bit, but the idea that we're going to drive off the cliff like Thelma and Louise, I don't see happening.
All right, thank you. Now we're going to move on to inflation. For several years now, the biggest economic headline has been the inflationary pressures on the economy, a trend very few developed economies have been immune from. We've seen favorable trends here over the last few quarters, but we're looking at a sustained level of inflation over the medium term. Or are we, sorry, that was a question. Are we looking at a sustained level of inflation over the medium term, or can we expect further cooling in inflation to return closer to the 2% target?
Yeah, so this is a good news, bad news story. The good news is inflation has certainly come down from its peak. I'll offer you a caution before I go through these charts. Economists and politicians talk in rate of growth change. Mm-hmm. People live in absolute change, right? So when you look at these charts, on your top right, CPI, Consumer Price Index, you can see the big spike in inflation coming out of the COVID, driven largely by the supply constraints, the supply disruption that COVID brought upon us. Same thing with PPI, which is the Producer Price Index on the side, and then on your bottom right is your PCE deflator. That's the personal consumption expenditure deflator. I know that's a mouthful. The reason why it's there, it is the Fed's favorite inflation target. So you can see the big spike. So using CPI in June of 22, inflation, the rate of growth of inflation peaked at 9.2%. It's currently around 2.8. So good news is it's come down a lot. The bad news is, and again, I'm using the core PCE because it's the Fed's favorite number, and we use core because it excludes food and energy because Nobody needs food and energy. We'll just throw that to the side. I don't get it. I'm an economist, I know, but I never got this. But this gives you the good news, bad news. The good news is you can see, starting in September of 22, where this chart starts, where this index was at 5.5, you can see that it's come down to 2.8. So that's the good trend. The bad news is, I don't know, if I look at the last 6 months, we've been between 2.7 and 2.9. To me, that's a flatlined inflation. It's stabilizing at 2.7% rate of growth, which is much better than a 9.2% change of growth. But it's still substantially above the Fed's target, which is 2%. And this stickiness that we see has begun to kind of filter its way into the interest rate market. And interest rates, again, managing expectations, the title of my deck here. I'm not sure you're going to get the relief in interest rates that people are hoping for because this inflation has remained so sticky. And why is this such a contentious issue? Again, as an economist, I'm going to talk about rate of growth. As a consumer, that top line is the consumer price index. So if I look at the consumer price index over 3 years, it's up basically 20%. That's the pain we feel at the grocery store or when we go to Home Depot. And that is real painful. And in particular, it's painful for the lower income stratas of our economy because when I look at that balance sheet, they don't own a home. They don't have substantial financial assets. They borrow a lot on credit cards, and the inflation is far more impactful. And this is why I think inflation was such a hot topic in the election and it continues to be a big focus of the economic discussion today. So, the fact that prices are up 20%, but only growing at 2.8, you're still growing off a very high base. And what you really want to see is this absolute number go down, and we're not seeing it. Inflation's proven to be more sticky.
Okay, well, now on to the new administration. We are less than 2 weeks away from inauguration and a shift in power that portends significant changes in federal fiscal and economic policy. As a backdrop to the change in the White House, the federal debt has grown ever larger over the last decade, and other major economies are starting to experience the headwinds of unsustainable debt loads. What are the key impacts you predict from the new administration, and what are some of the longer-run fiscal challenges that await newly elected officials in Congress as the new administration begins?
Yeah, so lions, tigers, and bears, oh my, right? I'm going to try to skinny down the impact of Trump 2.0 into these 3 circles, which is tariffs, taxes, and regulation and reform. So lots of noise around all of these topics. So the first thing I would observe is the stock market has rallied pretty substantially in the post-election environment. I would argue that is because of the taxes and the regulation circles here. So on the tax front was probably the most meaningful differential between the Harris and Trump campaign. And to kind of very briefly summarize it, we have the 2007 Tax Act with lowered corporate tax rates and lowered individual tax rates is set to expire in the fourth quarter of 25. The Harris campaign was advertising that they were going to take the corporate tax rate from 21 to 28, and they were going to let all the individual tax cuts expire. The Trump administration and Trump 2.0 promises to keep that rate at 21 and perhaps even make it lower. There's talk of making it 15% if you onshore some manufacturing, things like that. And there's a whole smorgasbord of tax things that I'm a little dubious of. Things like no tax on overtime, no tax on tips, no tax on... So the problem we have, and we'll talk about the debt and deficits in a second, is we don't have a lot of money to expend, and those things are expensive. But I think the market's reaction to the election, at least from a stock market standpoint, was corporate taxation wasn't going to get worse. We're probably going to get something close to what the status quo is. We're under the Harris campaign, the idea that rates were going to go up substantially. So on the tax standpoint, I think we got a little bit of certainty, which I think the markets reacted pretty favorably to. If we have time, we'll talk a little bit more about regulation, but I don't think I'm being a partisan when I say that the Biden administration had a very heavy hand when it came to regulation. Ask a Maine lobsterman if what they think about regulation, and I'm sure you'll get an earful. We talked about regulation in terms of real estate development. It's just really everywhere. Very heavy-handed when it came to mergers and acquisitions, things of that nature. So there's a general perception that things are going to be, the business environment is going to be more friendlier when it comes to regulation. And then there's a lot of noise about Doge and Vivek and Elon, and they're going to take $2 million. I literally, about 10 minutes ago, I was reading my news feed before I came up here, so I'm up to date, and apparently Elon Musk came out and said, well, maybe not $2 trillion in savings, maybe more like 1. That's not like a small adjustment to your forecast, right? Now, $1 trillion in cost savings when you're running a 6% deficit is still pretty good. So I think the concept that you're going to get relatively stable tax environment and a perhaps more friendlier regulatory environment, that I would kind of summarize in a pro-growth economic environment, and that is, I would argue, the main reason why the stock market has reacted so well in the post-election environment. The tariffs are the big uncertainty and the big question mark. And anybody who tells you they know exactly what's going on there is kidding themselves, because I don't think anybody does. And I would summarize the idea that that tariffs, it remains to be seen whether tariffs and all of the vitriol that you hear coming out of the 2.0, is it a tool in the trade negotiation toolbox, or is it absolute and we're going to have 60% tariffs on China? Every economist will tell you that tariffs are bad, but they forget the second half of the sentence. Tariffs are bad in a free and fair trade market. Does anybody think China plays free and fair? The answer is clearly no, and it frustrates me as I look at President Trump. He tends to have this exaggeration kind of bravado. If he said we are going to threaten tariffs unless these players become more fair and free traders, who can argue with that? Because it's very clear China is not a free trader. It's very clear that our friends and allies, so there's all this vitriol about, well, we're talking terribly to Europe and we're talking terribly to Canada and Mexico. They're not free and fair traders. So you look at this week where Nippon Steel was trying to buy U.S. Steel. U.S. Steel is going to go out of business if they're not bought by somebody. So we the government, talk about a heavy-handed regulation, declined that on a national security issue. I don't really buy. But the big issue with steel is China's dumping steel into Mexico. Mexico's stamping made in Mexico on it, and they're importing it into the United States at the favorable trade agreements that we have with Mexico. So the tariffs, if they come in the full-blown 60% on all tariffs from China and everything from China, 10% on everything else, will be negative. I'm hoping that it's more of a trade negotiation deal than they're going to be outright tariffs. The fear with tariffs goes back to inflation. Let's face it, we buy a lot of stuff from China. If everything goes up 60% in price, we're going to be paying a lot more for our air conditioners and our washing machines and our electronic products, et cetera. So I think we'll summarize I think the general reaction has been favorable to Trump 2.0 so far in the business community. I think it's largely because of the more friendly or growth-oriented tax and regulatory environment. The tariffs, if they come at their full promised levels, could prove to be inflationary.
Great, thank you. Now let's turn to another volatile sector of the economy, energy and commodity prices. Significant policy changes have occurred in these sectors, and emerging energy uses, most notably artificial intelligence, are placing new strains on our energy grids. How are governments and industry responding to these challenges, and how might global shifts in energy markets impact the U.S. economy?
Yeah, so I think energy is a really critical segment of our economy. And I think it's very important for the New England economy because you folks pay really high energy prices here in New England for a host of reasons that I'll try to talk about. But I'm probably dating myself here with a reference to Stanley Kubrick's 2001 Space Odyssey, but I don't know if you remember my buddy Hal from the movie, right? And we talked, so that was you think about it, I think it was 1969 that movie was made. So pretty good, and even my buddy Jimmy, I'm definitely dating myself because, I mean, Jimmy Buffett's dead and the movie was made in 1969. So I'm definitely dating myself. But, in his Fruitcake song, he talks about Stanley Kubrick and his buddy Hal don't look that abstract anymore. Well, here we are with artificial intelligence, aren't we? And the point here is not to talk about the merits or the impact of artificial intelligence. It's really to talk about energy demand. And if you think about what's happened over the last 10 years around the world, there has been this big shift to climate-friendly policies, to renewable energy, which is wonderful. But at the same time, those policies have shifted energy demand to the electric grid. So instead of driving a gas fuel car, you're driving an electric car. Instead of using a natural gas fueled heater in the home, you're using an electric heat provider. So we're trying to electrify a bunch of stuff. EVs was the first big spike in demand. The second thing that doesn't get a lot of discussion, but cryptocurrencies, the mining of cryptocurrencies consumes massive amounts of electricity. And now artificial intelligence, we're all agog about how cool it's going to be, and NVIDIA shares are up a gazillion %. Those chips consume so much more energy than anything that we've seen. So we've had this massive increase in energy demand while our energy grids have done nothing. And to me, that's a concern. So these are a little dated, but the International Energy Agency said that we're going to need 50 million miles of transmission lines, enough to wrap the planet 2,000 times to build or replace by 2040 the climate net zero goal. That's a lot of copper. And here's my point. Look at the quote on the other side. Now, copper prices and other prices have not done much recently. It's part of the deflationary story or helping inflation come down. But as I said, it's really difficult to stick a shovel in the ground. And that's if you want to build an apartment complex in Portland. Imagine trying to build a copper mine in Portland. And it takes years. So a quote from one of the leading CEO from Anglo American, which is one of the largest mining companies. We don't have a lot of new supply coming online around the world. What concerns me is even when the discovery is made, of which we've had several discoveries here in the United States of lithium and copper, it could take between 7 and 15 years before the first copper comes out. According to the copper industry, we are at peak copper production in 2024. So we're past peak copper with no new mines coming on project, yet a massive increase in demand. It's really difficult to square that circle without thinking energy prices are going to go up. In Germany, their economy's been in a recession for 4 years, largely because they killed all of their nuclear power plants in the favor of renewables, and then they got caught up in the Russia-Ukraine thing. And frankly, the United States has saved their bacon by shipping liquid natural gas there. And then lastly, I don't know if people caught up with this, but Microsoft and Constellation Energy formed an agreement to reopen the Crane Clean Energy Center. You may know this as 3 Mile Island. So there's one reactor there that wasn't affected by the accident back in 1979, and Microsoft is going to reopen that nuclear reactor with Microsoft getting all of the power generated by that nuclear reactor. That's how desperate AI or how desperate the energy situation and the energy demand is that we are talking about opening up nuclear power plants that had accidents. So I am very concerned about energy, and specifically for New England, you folks pay $9, $10 for natural gas, where in New York we pay $2 or $3. And it's, I think, a good example of kind of the regulatory burden / climate environment where our former governor in New York, Andrew Cuomo, prohibited a pipeline being built from Pennsylvania up into New England to ship natural gas up here to relieve your prices. All in the name of we're going to eliminate fossil fuels and they're evil and they're bad for the economy and we don't want to facilitate the use of fossil fuels. Well, that's great. You people are paying $10 for natural gas, 3 times what the national average is. And so I do believe that AI and just the massive increase in demand for energy is forcing us to have a kind of come to Jesus meeting when it moment when it comes to energy, because the demand, because of AI, because of cryptocurrency, because of the electrification of so many different things like heating homes and driving cars, the demand is exponentially growing and the supply can't keep up. And that is a very big concern of mine from inflation in the long run. And I think it's particularly important for New England and Portland specifically, because you guys are really on the wrong end of the energy curve.
All right, well, now let's pull various threads of today's conversation together and summarize what all these interesting trends and economic input signal for Fed policy and corporate earnings. It seems like across the board, massive economic shifts are afoot, and previous assumptions about macro trends are being revisited in light of structural changes to the economy. How is the Fed responding to these changes? How is their approach shifting to fulfill their mandate of maximum employment and stable prices? And what does this mean for the future health of the U.S. equity markets and corporate earnings?
Yeah, so I don't envy Jay Powell. I think he's in a really difficult spot right now because inflation, while it's moderating, has remained stickier than they want. And at the same time, it frustrates me a little bit as an economist. And I was sharing with somebody, in our conversations this morning. It frustrates me that if you talk to the Federal Reserve, they refuse to talk about the fiscal policy of the government. The Federal Reserve controls monetary policy. There's the fiscal policy, which is Washington, D.C., and that, I would argue, is the major cause of inflation, has been just the incredible spending that's occurred, some of it in the name of protecting the economy for COVID, but since then we've spent an awful lot of money. And it concerns me that debt levels are starting to go up, and you can see it here. The question is, how the politicians get away with the debt rising as rapidly as it did. And I think the answer you can see in this chart is we've had 0% interest rates for effectively 10 years, going back even more. We've had extremely low interest rates, 0 for a good portion of it, going back to the financial crisis in 2008. So when you look, the debt is growing exponentially, yet the payments, the net interest expense, essentially flatlined because interest rates were effectively 0. So you could spend more, or at least so we thought. But sooner or later, the chickens come home to roost, and now you can see the projection of interest expense. So in 2025, the United States government will spend more money on interest expense than they do on defense. Pretty scary, almost 14% of our total budget. And I joked about Elon Musk going from $2 trillion to $1 trillion. $1 trillion would be fantastic. I have always been cynical or skeptical of that savings. And the reason for it is this chart here, the pie chart. When you look at the government spending, Social Security, Medicare, Medicaid, other mandatory programs, which is basically pensions for government workers, if you take those gray slices of the pie and add interest, so go from, say, 11 o'clock to 7 o'clock, that's about 70% of our budget, and it's on autopilot. Both candidates, Trump has reiterated it, and Hakeem Jeffries, who's the minority leader in the House of Representatives, you're not touching Social Security. Okay, 70% of your budget is off limits. Now go save $2 trillion. Well, you only have a $6 trillion budget. So you're going to save 30%, so if you're Elon Musk, you're going to save $2 trillion on a $6 trillion budget, but you're only going to touch 30% of the budget. The math just doesn't work. It's really, really hard. We are spending incredible amounts of money. I find it, I read a fabulous piece by one of my favorite strategists from JP Morgan, and he goes through all a litany of things, and it's like, well, this could add up to 1.5 trillion, but he then goes and says, well, that will be really hard, and it's only 50. And I went through the paragraph by paragraph, and he's like, well, we can't do this because of this, we can't do this because of that. So for example, there's $250 billion of incorrect payments in Medicare and Medicaid. Or, well, 100 billion, and then you go through student loan payments, all these other different things, where the government wastes $250 billion a year. Well, you say, well, let's just make people pay their fair share or pay their bills appropriately. But it would cost more than that to build a software system to do that. So, well, we really can't do it, but Washington has this thing, it's like, well, we can't do that 50, we can't do that 50, we can't do that 25, we can't, and the next thing you know, well, that's $1 trillion. And so this, to me, is really problematic for the Fed because of the fiscal policy. And what's happening, and we just did this this week, we issued $120 billion of 3-year notes, 10-year notes, and 30-year bonds, and we call it the quarterly refunding, and it was $120 billion of new debt. And so this starts to go up, but as the supply of government bonds go up, what we're starting to see is interest rate, the demand for investors to say, wait a second, this fiscal situation is becoming alarming. We're going to start demanding a little bit more. So I think that makes the Fed's job much more difficult. So where are we with Fed policy? Back in September, Chairman Powell talked about recalibrating policy, that you had that rapid rate increase, and that was a historically fast rate increase. The magnitude of that rate increase was amazing. And I think the Fed and economists in general were shocked that that rapid increase, 525 basis points of rate increase in basically 18 months didn't choke and cause that recession. I would argue it's the strength of the balance sheets of both corporations and consumers that allowed us to weather that because, hey, if I refinance my mortgage at 2.5 and the mortgage rates go to 7, what do I care? Right, I'm not moving. So the rate sensitivity of the overall economy because of all the stimulus and reforms that came out of COVID, I think provided some insulation to that rate increase. You can see the long pause, and starting in September of last year, they started recalibrating their word, and they have subsequently cut rates 3 times in 2024. They did it again. I sent this to the chamber here before the last rate cut. So 100 basis points of rate cut. But managing expectations, as the title goes, I think is really important because inflation has proved to be stickier and the economy has proved to be stronger. I was listening to Austin Goolsbee, who is the president of the Chicago Fed, and he was basically saying that they still feel that monetary policy is restrictive. And I'm watching it, and I'm sitting there saying, well, let's see. Economy is growing at 2.8%, significantly above trend. Unemployment is at full employment, historically at low levels. Inflation has trended down. You have a stock market trading at record highs. You have credit spreads in the financial markets at record low levels. You have speculative assets like gold and cryptocurrencies going through the roof. And they believe they're restrictive. I'd hate to see what stimulative was, right? But what is N-star? So N-star is what they refer to as the neutral rate. So for you Naval Academy fans, I stole your emblem for this chart. But N-star is the neutral rate where the Fed sets policy that's neither stimulating nor restricting economic growth. And it's this metaphysical, cool thing to talk about. So when you ask Austin Goolsbee, are rates restrictive? Yes, they're restrictive. What's N-star? I don't know. Well, then how do you know it's restrictive if you don't know what the base rate is? In short, what I think is happening is the expectations, if I go back just 4 months ago, was that the Fed was going to cut rates 4 to 8 times in 2025. Now we're looking at best at 2. And if the economic numbers remain as strong as they have, I'm not even sure you'll get one or maybe even 0. And so as it comes to rate policy, I'm not sure, I particularly for investors, I would urge you to manage your expectations because I do not think you're going to get massive cuts in interest rates, and nor do I want them. I think this is a great, be careful what you ask for a moment, Mary, because the last time we got really low rates, the last two times, we had a financial crisis in 08 and 09 and this horrific COVID pandemic that killed millions of people. If that's what it takes to get to zero interest rates, thanks, I don't want it, right? Credit spreads, if the economy was running wild, or inflation, you would expect credit spreads. So the best example on this chart, so the blue line is high yield bonds, the red line is investment grade bonds. You can see what happens in a crisis when you can sit and you look at 08 and the financial crisis. We're nowhere near crisis environment there. And the yield curve is flattened a little bit. This is more for bankers. But this is a chart I want to share with you, and hopefully this will help you manage expectations. The blue line is the yield, the nominal yield on the 10-year Treasury. And you may not be aware of it, but this is the benchmark where just virtually all lending in the commercial world is benchmarked off of this, right? Whether it's a mortgage or a commercial loan. There's all these different iterations of SOFR and this, but this is the linchpin, it's the 10-year Treasury. So the blue line is the nominal yield. So today, it's basically 4.7%, give or take. The red line is real yields, which basically backs out inflation. So that spread between the blue line and the red line is basically inflation. When I go back to 1958, inflation has, the real yield has averaged 1.93% above inflation. So that's, I'm going to round that off to make my math easier to 2%. Fair? 1.93, it's close enough. So 2%. If that's the historic spread above inflation, let's give the Fed the benefit of the doubt and say they get to their target of 2. I know it's early in the morning, it's cold out, but 2 plus 2 is 4. We're at 470 on the 10-year Treasury. So is there room for interest rates to come down? The answer is yes, based on historic parameters. But they're not going to 2. So the people who are hoping, I've shared this story, some of you have heard me speak at other events here in Maine, but my son, who bought a house 2 years ago, at the time, locked in on a mortgage at 6%. He said, Dad, I think I'm going to wait for mortgages to go back to normal at 3. No, 3 was not normal. That was the abnormal part of our program. A 7% mortgage, while it's very high and clearly impacting the housing market, that's not a historically bad rate. And so I think this chart helps you manage expectations. So I think the Fed wants to cut rates, but the data hasn't been cooperating. And even if they do, I don't think we're going back. So that end star, which was projected to be in 2.5–3% range, is more than likely going to be 3.5-ish. And that has implications for all the other interest rates.
Thank you. If anyone understood half of that and you have a question, I'm just kidding. I actually understood, you did a really good job. I actually understood a lot of it. But if you have any questions, now's your moment. Tommy will bring you the microphone.
Good morning, everybody.
Morning.
Good morning, everybody. Jake Nadas, Times High School Credit Union. Today I want to speak on behalf of my fellow 20-year-olds, young professionals aspiring to buy a home. Average cost of a home is over $400,000, 7% rates. You'll take average earners, higher earners at our age. Pretty difficult. What would you say about the next, say, 5 to 10 years based on affordability or where we are in position in this market where we weren't quite ready during COVID, where mortgage rates were 2 to 3%. What does this look like? Do we see more support from the next administration, obviously, or federal level?
Yeah, so the question is really revolves around the affordability of housing, and particularly for the younger generation. My son, a really good example of it. It's a really challenging environment. The other anecdote to my son's experience is he put bids in 2 or 3, 4 times and was constantly outbid with cash bids. And as an economist, I'm like, where are these young people coming from that have $450,000 in cash to put down? And the answer wasn't 30-year-olds with 400,000. It was baby boomers downsizing, selling the big house at 800 because they're retired and the kids are gone, sell the house for 800, pocket 400 and go on a trip and pay 400 cash for that house. But what that did was it took that 400 house and made it 450. And they came in and put in a 435 bid, but because of 450 cash, it went to the cash bidder. So based on my presentation here, I don't think, I feel for you people. I really hope mortgage rates can come down. I do think there's some hope that there was an article in the Wall Street Journal that the spreads that mortgages trade at relative to treasuries, risk-free versus a mortgage, is historically high. So there might be some benefit of rates coming down a little bit, but I don't think you're going to get material help from the interest rate reasons for all the things we talked about. So it really comes down to we got to get, there is universal agreement that we don't have enough housing. We have to make it easier to build houses. And that's where, as I talked about earlier, I'm hoping that the regulatory environment gets a little bit better. My caution to you when it comes specifically to housing is the regulation of housing is more of a state and local thing, not a national thing. So you may get a little bit of help from a federal level, but it really is the local governments that need to kind of help expedite development. And I'm not sure I see that happening yet, but so I'm supposed to make you walk out of here feeling better, but I can't.
Okay, yeah, Pete Nikitas. Thanks. That was an outstanding presentation, very informative. Someone's going to have to ask a question. They'll make everybody feel good when they hear the answer. But this question is more about what's the end game with this deficit? I mean, is it likely that we'd monetize, we'd default? Do we wind up looking like Japan at 250% of GDP? It's easy for everybody to understand what it costs for a gallon of gas or a gallon of milk. I'm not sure that everybody walking up and down Main Street really understands what this will all look like if we just continue to allow this deficit to grow and grow and grow.
Well, it's a pretty good question. I do think that for my colleagues at NBT Bank, so the question really revolves around the fiscal policy, the spending levels, the debt levels, the impact that has on interest rates, basically pushing them higher and impacting economic growth. Is there any hope there? I will tell you, I've been doing this speaker thing since 1997, and that pie chart and those graphs I showed you have been in every presentation I've done since 1997. So I'd like to say I'm optimistic, but I've been given the same presentations since 1997, so we're pushing a pretty long period of time. That being said, I do think we're at kind of a turning point where I think a lot of people understand that the spending level can't persist at the levels they are. Those charts I showed you in terms of when you go back and you look at those debt levels, this is not sustainable, and everybody gets it. It's really a question of how. And I would suggest to you that I think politicians and folks on both sides of the aisle are coming to the understanding that this has to change. And I think, there's, the Republicans are like, cut spending. Well, Elon Musk just told you how hard that is to do, and that pie chart when 70% is off limits, it's really hard to fix this problem unless you address the entitlement programs. And right now it's off limits, but it's going to have to be. It's just math. It's like me going to you and saying, you need to cut 20% out of your household budget, but you can't eliminate your mortgage, you can't touch this, you can't do that. So it's like, okay, I'll eliminate eggs. Well, great, that's $250 a month. Now where's the other $1 billion coming from? And so it's really hard to fix this debt problem without addressing entitlements. It's currently viewed to be off limits, but I think there's a general realization that this is not sustainable. And I think it's going to require some degree of compromise because I am not a fan of taxation. I think it's an impediment to growth. and I would much rather see it in the hands of private industry versus the government. But taxes are going to have to go up to fix this, and spending is going to have to come down. And so I think everybody's going to have an ox that's going to get gored in this, and I think we're getting to a tipping point. And the way I think it manifests itself, and I would argue we're beginning to see it now. So think about this. The Federal Reserve started cutting interest rates in September and cut 100 basis points starting in September, 25, another 50 in September, 25 and 25 November and December. So it brought the Fed funds rate from roughly 5.25 to 4.5. Over that same time period, the 10-year Treasury has gone from 370 to 470. Why? And that's, as I said, that 10-year note, that's the note that we borrow at as businesses. That's the rate that we want to worry about. All the headlines are Fed funds rate, the Fed funds rate. Well, that's an overnight rate that banks lend and borrow to. It's a short-term rate. The real rate is the longer-term rates, because that's where commercial loans and residential mortgages and development mortgages come from. That rate went up 100 basis points since the Fed cut. And why is that? Because markets becoming concerned about spending on the federal level. They're becoming concerned that inflation's proving to be stickier, and it's starting to manifest itself. And the massive supply that you see coming out, 120 billion in 3 days this week, is starting to put upward pressure, what they refer to as the term premium. The longer the term, the higher the rate goes, because you're worried about these things. And that term premium is starting to rise, and N-Star is starting to rise, and that's when it begins to affect our pocketbooks. And that's when this kind of nebulous economic debate becomes a little bit more. So I think it's starting to hit home, and I think you're starting to see it in the interest rate environment, and that will be the mechanism that gets people to pay more attention to it. That's my hope.
We've got time for one quick question in the back.
Thanks very much, Ken. I got to say, you are probably the best. You ought to have your own podcast and go public. Having said the nice things, I just have a comment and a question. I really think I'm glad you just mentioned recently in the last few minutes here raising taxes. I don't see a way out of this without raising taxes, and I go back to the federal tax rate structure right now that the Democrats want to change versus the structure that Trump wants to maintain. I just think you got to go after some of these higher income folks, which gets me to Elon Musk. And just a short political statement: the man invested $250 million in Trump's campaign, and the value of his stock holdings went up $150 billion, which I think we could agree is a pretty good investment. But having said that, going back to some of the things you've talked about, I want to focus a little bit on multifamily housing, large commercial construction, and how interest rates have affected that. The way I look at the scene around Maine and New England and probably the rest of the country, these higher rates, largely based on the 10-year, have totally throttled down new construction of multifamily housing, larger projects. And I'm wondering what your thoughts are on that, and how the banks who make these loans, how they're viewing that situation right now. Thank you.
So the question really revolves around real estate development and bank lending. The idea that banks have stopped lending is just not true, at least at MBT Bank. And Mike Riley and Mark, we have a bunch of lenders here from MBT. We had record loan growth last year, and our loan book has never been bigger. So the notion that banks aren't lending, I'm sorry, that's garbage. That's not true. However, the government does make it very difficult to lend to certain areas in the marketplace. And I think for residential real estate, there has been this, again, driven by climate thing, a push to push everything into the cities. But I really do, so I don't know, the rates are the rates. We really can't control them. And if you want to wait for rates to go back to 3%, good luck. I don't think you're going to get there. It doesn't mean the 10-year Treasury can't go from 4.70 to 4, but it also doesn't mean it can't go to 5.5 either. So I don't think there's an unwillingness for banks to lend. I think the general the general idea that there's Armageddon in real estate is not true. It may be true in major metro areas in the office real estate part of the segment, but that is one segment of real estate. Take the flip side of it. How do you think data centers are doing with all of this AI stuff? They're off the wall. They're just growing like crazy. So I think, I was talking to a colleague, a customer of the bank who's in the real estate, and many of you may know me. I've been at Merita a couple of years now. It amazes me that we have this desperate need to build single-family units, yet we're mired in discussions about how many parking spaces there are. And we don't want to have too many parking spaces because, that will allow people to use their cars. So and that's what we're discussing is parking spaces. You're 4 million houses short. Maybe we should have a little bit bigger picture. And so from the real estate perspective, again, I think we need to come up with a more reasonable cost-benefit analysis on a regulatory front. Not to say that some of those climate goals are not noble, they are, but the immediate need is that we have a lot of demand. And if we're going to help this 30-something-year-old gentleman buy a house, we need to increase supply, and that takes time.
All right, well, thank you, Ken, so much for joining us this morning. I wanted to quickly tell you about two upcoming events, and they're both, next week is a really great event. If you've never been to a Propel event, Propel is our young professionals. They have their Ignition Awards event next week. It's a really great event. There's great energy at these Propel events, and it's at Allagash. So next Thursday, the 16th, 5 to 7:30 is the Propel Ignition Awards at Allagash. Please attend. And then the next Eggs and Issues will be February 13th, and we're going to hear from Wade Merritt, president of Maine International Trade Center. So see you either next week or on the 13th of February. So thank you so much.
Thank you, everyone.